Hey everyone, welcome to another video. So today I'm going to go over something called ranges. I'm going to teach you how to trade ranges, and this is not a new concept. It's something that's I'm sure a lot of people already are out there doing. This is something that I learned, and it's been very effective in helping me to understand where to take trades from, whether I'm on the higher time frame or the lower time frame. A lot of times we think that the only trades we can catch are at the extremes, whether we're looking for continuations or we're looking for reversals, and not everything needs to be traded from a swing perspective, but it can be taken on a lower time frame, whether we're taking a reversal at an extreme or we're taking continuations in the middle of a leg, right? And so this is kind of the idea behind this. The link to this will also be in the comments or in the description of the video, so you can click on it for more clarity. The whole idea behind these ranges, and I'd like to read off of what you can see here. Ranges provide great opportunities for entries. The development of a new range requires a lot of capital to form. Therefore, because of that, on the lower time frame, what they really are just basically are accumulations or reaccumulations before more expansion. Let's say in this case, like in a demand, we have another reaccumulation, an expansion, reaccumulation, expansion. We meet a higher time frame supply in this case, for example, for this example. And what happens? Well, now we are, market structure tells us that we are expecting to make a lower and lower low, and this is going to be a lower high, and therefore it's going to respect the supply zone, and we're going to get a shift. And in this case, it's in the form of a complex pullback, and now instead we have an expansion back to the downside, a redistribution, right? Expansion to the downside, redistribution, expansion to the downside, kind of the same thing, right? So when we're trading, a lot of times some people forget that, we are the small fish in the pond. There are $2 trillion a day in liquidity and volume just on Euro US dollar alone per day. And so it takes billions and billions of dollars to make these zones, and therefore the people who are creating these levels of support or levels of resistance or levels of supply and levels of demand, whatever they're doing, inside of these ranges there's a lot of buying or a lot of selling going on, right? And before we have a breakout that usually follows the expected order flow, what we can expect is billions of dollars are going into forming those positions. And so these positions now become protected until we form or create the higher time frame structure that we're pursuing, right? So if we're at this low and we're expected to make a lower high, then these areas are going to be protected until we fulfill that lower high expectation. Once we fill that, now there's no more reason to protect these levels because these were only buying to create that lower high. And once that level is, let's say, satisfied, these now become targeted liquidity for us on the way back down. And you can see usually when we come into these zones, what we expect is not a complete reversal, but a pullback of some sorts. And those pullbacks create more opportunities for redistributions or reaccumulations, but at the same time they offer you opportunities for re-entries. And a lot of times you're going to find that a range after the expansion, whether it's downward or upward, a lot of times price will come back to mitigate something in that area, no matter what time frame you're on. Of course, on the lower time frame, you're going to see more opportunities because it's easier to move a couple pips, right? Versus if you're looking at the 4-hour, it could be several days or even weeks before price comes back to mitigate one of those zones for continuation, right? So that's kind of the idea. The other thing is I like to focus a lot on resting liquidity. And if we look on the right side over here, one thing that I'd like to emphasize is just because you see relatively equal highs or relatively equal lows doesn't mean that we are going to immediately pursue and liquidate those positions. Those can also be left for later down the line. And that's the whole idea of what I'm trying to explain here, is that when we come back to these zones, it will serve as liquidity, and they will basically serve as opportunities for pullbacks. So if you can see, let's say if this was a swing structure, we're in a bearish trend, and you can see here we have this pullback, right? And what we've done is we failed to break the low, we failed to break the high, we've made relatively equal highs, but this then becomes a strong level as this is responsible for the break to the downside, right? And so now we have a lot of liquidity here from people thinking the price was going to buy, and people who were going to short from here also that were selling up at this level. In a range, there's a lot of liquidity. You have both people at the bottom of this range, let's say buying, trying to push price long, right? And then you have people at the top of the range who are shorting and pushing price lower. And so there's a lot of, in this case, distribution of orders, but obviously the higher time frame market structure is going to continue to be fulfilled. And once we get that push, last push to the downside, and once we have, let's say in this case, we have a reaction to supply, we created, let's say we failed to create a new lower low, and now what we do is we take out a previous lower high. We are now changing or shifting market structure. Momentum and volume is now favoring, let's say, bullish momentum. In this case, we did get an exchange or an interaction between buyers and sellers. We came into this supply, we reacted, we formed an extreme. The selling from this reaction to this supply was not strong enough to continue to the downside and create a new low. Therefore, this is going to be a weak high, and so the expectation now is that we are going to basically reject or create failure of the supply, and that's where we get this explosion to the upside. And what are we pursuing? Resting liquidity. In this case, what could we be expecting? The most recent resting liquidity in this case would be these relatively equal highs, right? We pursue that, we sweep it, and we get a pullback, of course, right? And then we continue to the upside. And so this is something that we're going to go over. Now, there's a lot of, let's say, subjectivity to how you decide to mark out your ranges. Some people will have very strict rules. I prefer, in most cases, to use body candle closures because sweeps happen often, and I don't like to consider a sweep, let's say, confirmation. I like to only use candle body closures, unless in some rare cases it'll make sense, which we'll go over, right? Now, there's four kinds, right? We have either let's say bullish scenarios and we have bearish scenarios. The most likely that you're going to come across are continuations. I don't want to say like a percentage, but I mean, if you think about it, like 90% of the time, price is following continuations. Only when we get to an absolute extreme, when we're forming, let's say the top or the bottom of a swing structure on a higher time frame, only then are we getting the reversal scenario, right? But we also don't want to get mixed up with that, right? So one tip that you can use to draw ranges that will definitely has helped me is, let's say if we're expecting bearish order flow, then what we're looking to most of the time come down, make a low, form a high, and then take the low. That's when we continue back to the downside. And so in this case, for example, we have a lower low, a lower high, a lower low. So in this case, in most cases, the range, the first point you're going to be drawing from is the low of the range to the high of the range. And once price exits out that range, exits from the low to the high, takes out the low level, now you have a confirmation of this range. And so now we're expecting when price comes back up to mitigate this range. If it has not yet fulfilled the higher time frame market structure and formed the extreme, then we're expecting this to be respected, and more than likely, more than anything, this will serve as resting liquidity to continue to the downside. Same thing if we're bullish, right? Just the opposite. We're expecting what? Price to continue higher, and so we're expecting the first point will be a high, then a pullback, right? We can be building liquidity or whatever, something like that, either on the way down or on the way up, and then we get an explosion back to the upside. So when we're drawing, let's say, ranges for continuation bullish, usually we'll take the high, then you mark out the low, and you just drag this across until, what do we get? An exit from the high. And that will be your two best cases to use ranges for and continuations. Now, in the case of, let's say, reversals, what it really truly is it's basically failed expected range, right? So in this case, let's say if we look back here, the expectation is that we continue, let's say, bullish, correct? But taking into account of what? The higher time frame market structure and protected supply levels, let's say on the higher time frame all the way, let's say, to the left. Well, in this case, let's say we tapped into that and we respected that level. What can we expect? A pullback. Now, instead of saying that this is going to go bullish, we don't have a confirmation of what this is going to be until we get a breakout from either side. So in this case, what do we get? We respect the highs, therefore we are not confirming this as a demand. What do we get? We get a supply range. And so in this case, this is a reversal. So this tells us what? We have a higher high forming, we have a higher low, and this is now a lower high that respected the supply or made equal highs, right? This means that this is a strong level, supply is holding, and if we can cause a break of structure to the downside and a change of character, momentum is shifting, in this case, from bullish to bearish, right? We break structure to the downside, we take the low, we fail to make a new high, therefore this area, this low is weak, and we're going to shift because we tapped into a higher time frame supply. Now if we look on the left, the bullish, let's say, reversal, in most cases, what do we have? Prices coming to the downside like this, very aggressively. And what do we have? A lower low. Price makes a lower high. We're building liquidity either here or on the way up a little bit. We come back, we tap into, let's say, the demand. And now what we get is confirmation that we are not going to break the low, that we are going to respect the lower low. And now we have creation of a higher low or equal lows, and we get an explosion to the upside. So in this case, our expectation before we saw that explosion to the upside is that we take the low to the high, and our expectation is we're going to take the low and continue to the downside. But when we get confirmation of the range through a candle body closure outside on the upside, now we have the understanding that this more than likely was a reversal, and that this is now going to be protected level. And we could come back to mitigate it in some cases, but more than likely, this is going to be the extreme low of the next swing, right? So this is something to keep in mind. This is what we're looking for. I'm going to save this so you can take a look at it later, and it'll be in the description. Hopefully this does help you with the understanding, but let's get into some examples. Now, there's a lot of subjectivity to how these apply and how you decide to use them. So I'm going to show you how I use them, and hopefully you can figure out, let's say, a way that they better apply to you, what you like to use them for, whatever, right? So let's say we have these buy to sell wicks, right? They got engulfed. We have price that came into this higher time frame supply that's in control. So this is daily supply. So just keep that in mind, right? Let's go down to the 15-minute, and I'm going to show you how we can use ranges. Now, ranges alone, I wouldn't trade an entire range simply because my stop loss would probably be way too big for my comfort. Now, for a lot of people that are trading with like 5, 10, 20 pip, or some people are like have 50 pip stop losses, whatever your strategy is, if this works for your trading plan, trade the whole range. Who cares, right? You could be very successful if you get it at the right time, right? In my case, I prefer to use the range as something that I'm, let's say, eyeing to see a mitigation, or if price comes back to that area. And then what I'm doing is I'm on the lower time frame looking for a reaction, some sort of confirmation that that range is going to hold, and then that's when I get my entry, right? So I use, let's say, a supply zone within the range. So I wouldn't take the trades as I'm going to show you exactly, but in some cases I will, and I will show you when those apply, right? So first things first, price comes in, we tap into this higher time frame supply. Now what do we have? A reaction. Price comes down, forms a low, forms a high, exits to the bottom. We don't get a candle body closure until here, right? So what is that? That's the continuation. And here, by this, I'm drawing most of these examples like this so that you can see what happens here, right? Our expectation is that we take out the low, because this is just a basic continuation range model, I guess you could call it, right? We're just gonna go, I guess it's not a change of character in this case, but we're just gonna put this line. So that's what we swept. We swept the bottom, right? We're continuing to the downside. Now, if price came back up into this range after it exits, if we get a full candle body closure beneath it, then when price comes back into it, if it comes into a supply zone that I like, I will take it, right? In this case, it might be too early, so I'm waiting for further confirmation or something that looks a lot cleaner, right? Same thing. What do we have? An engulfing candle to the downside. We form a low, we make a high, and we exit to the downside. What do we get? An explosion, another fast engulfing candle to the downside. So this is very strong momentum. So what do we have? We know that there's volume in here. This is something that I absolutely would trade. I would take the wick and I would get an entry at the wick, or I would take the entire candle and I would go short. And this is how you trade on the lower time frame. Now we're on the 15-minute time frame, but you could be trading the wicks and get, on lower time frames. You can also be on the 1 minute, and I'm going to show you 1 minute examples later. And let's just say where our expectation is that this is going to be a higher time frame, the lower high swing, and now we're expecting a lower low. We can drag this all the way to the bottom of the chart. Obviously, all what we're seeing on the 15-minute is this is like 18R plus, and as you can see, we never come back to that level. So we can even continue even lower than that. But the whole idea here is to show you that inside of this range, we have a strong supply, broke structure to the downside. It's a buy to sell that got engulfed. Price comes back in, wicks, taps, gives us our opportunity for an entry, and continues to the downside. And this never gets tapped again. So this would have been a beautiful entry just trading off of a range, right? Another thing, we have a lot of noise here. I mean, on the lower time frame, it's going to be very clear, but I'm on the 15, and to me, this doesn't interest me. It's too messy, so I'm going to wait for something more clear. Price comes down, makes a low, makes a high, and then what? Continuation to the downside. In this case, what do we have? This is a high, this is a low. You can see how strong the push down was. In this case, looks like we're forming a complex pullback. So what do we have? We have this low to this high, failed to take out the low. So this is right now, remember, we don't have a bias until it's been formed yet. Once price breaks out from here and we get a candle body closure here, what do we have? Well, this is a demand range, right? Now you have internal ranges that you can draw in here, but it's up to you, to your discretion, whether you want to use smaller ranges or bigger ranges. In this case, I'm taking this low to this high. I expected for this to continue to the downside. It did not. So what's happening? More than likely, we have a complex pullback, and we're waiting for price to come in to mitigate a supply. And we have a strong area here of interest. We have a buy to sell, right? We have buy to sell wicks in here. The wicks get engulfed to the downside. So we have a range here that broke structure to the downside. So we can expect this to probably be mitigated, right? We have another internal, let's say, demand range. We have this high to this low, takes out this high, candle body closures here again. What do we get? Price pushes to the upside. We're looking for mitigations of something down here. If price comes down to a high quality demand zone that I'd like, I would maybe take it long, because at this point we potentially could be having a temporary bullish pullback to the higher, or not the higher time frame, but to the 15-minute supply zone, right? What do we have here? This high to this low, breakout to the upside. We have another high to low to the upside. What do we get here? Now we tapped into that supply range, and what do we have? This is a supply range, right? So we have this low to this high. You can just take the whole, let's say, range in here, because we have all these messes of ups, downs, up, down. So I'm just going to box off this whole area. We had expansion to the downside. Price does what? It takes out this demand, right? This demand range. Now this isn't necessarily one that's very strong. It's the one just before we push into the supply. The supply is obviously stronger as we are coming from what? Higher time frame daily supply zone, right? We've already pushed to the downside. We've shifted momentum from bullish to bearish. So we can expect that any bullish or let's say long trades, any counter trend trades are simply going to only be until the next strong supply zone, right? And what are we taking? Any supply zones we're riding all the way until we form a new leg, right? So now what do we get here? We have this extreme, price pushes down, make a low. Let's say we have this fail to make a new high because we still have this wick up here. Low, high. So we're forming a range here. We're going to box this off. What do we get? A buy to sell that's engulfing. This sell breaks structure to the downside. It takes out what? Takes out this reaction to what? This demand, right? So this demand was a valid demand range. We broke, or we came in to tap it. We swept the high of this range. We failed to make a higher high. We broke structure downside and we took out the reaction and the extreme of this demand range. All right, so what's the next move? So let's just say we're coming from this higher time frame supply. So let's say if we go based off of market structure, we have a good pullback here. We're doing this. We come into the supply. This is now what? A lower high. We make a lower low. What's the expectation? That we're going to respect the lower high and make another lower low, right? Now what do we have happen? This engulfing candle initiates another push to the downside that what? Breaks structure. Look at this, right? So this was the low, lower high, lower low. So now this area is strong. We have the extreme and we have the decisional. This is a pretty good range. Now the extreme, what did it do? It didn't really break anything because this is, let's say, the more stronger low that pushed into here. All this was a small pullback, not enough to be considered in my case, but something that I still want to eye for reactions, right? In this case, when we took out this level, let's mark this out. Let's mark it red. Now we have these two areas, but this one had the strongest reaction. This one also swept. So internally we swept and then we broke structure to the downside. This one came into respect, pushed to the downside, took this, let's say, gave us a change of character by taking the push in. And what do we have? Let's see. So we're looking for price to come into what? I would personally prefer to take a trade like this on the whole candle. Now sometimes we won't get that. In this case, price may be tapped in. It depends. It's really close. It's not perfectly clean. Now, if somebody was going to take the whole range, right, or 50% of the range, let's say the whole half of the range protecting the high, yeah, you would have been in for sure. The other thing is, I mean, this just depends more on broker spread, but you could have taken it like this, right? And then the expectation is what? Every time we get a range, right, the break structure to the downside in this continuation format, right, and it's unmitigated. When we come back to tap it, especially in a complex pullback like this, we can expect this to continue and to not get breached. So we can move this all the way down as if we were going to form a new leg, right? And we feel pretty confident about that. So this reaction where we have a wick came down to sweep, we took out this initial sweep, so this low to this high, break a structure downside. If this came back to get mitigated, we would take a trade, right? In this case, we kind of have a mess going. You could, if you wanted to, you could take the wick. In this case, the wick is pretty big. I'm just going to take the range like this and wait for a candle body break. We get a candle body break here. So what do we have? We have a move. Well, actually, I forget that I draw these on here, right? So here, what do we have? We're building up liquidity. We run the let's say sell side liquidity, push price lower. What do we get? An immediate push back up. In this case, once we get the candle body closure, price comes back to mitigate what? This buy to sell that got engulfed. So this could have been a good entry too, right? I forgot to mention this one. So this drawing here, price came in. In this case, not the extreme, but the decisional that got the reaction. We came in, tapped it after we built liquidity that we swept. All this liquidity was swept. Same thing here. So this was a low. When do we break that low? I wouldn't consider the wicks a break. That's just a sweep. But but when we get this candle body closure, that's when we get the break. And so this was responsible, this buy to sell, that also swept the highs internally, right? That was responsible. So this wick here would have been a beautiful entry, and it's very valid. Next thing, what do we have? In this case, you could say we take the low to the high, right? So you can either do it like this, continuation to the downside, or you could have just gone like this, taken the high to the low to this fail to, make equal highs or whatever. You could have drawn it like that. It's more up to your discretion of how you decide to do it. Let's just say we keep it like this. It doesn't make a difference anyway. Then we get what? A new low, a new high, and this is a buy to sell that gets engulfed. And anytime that we have buy to sells that get engulfed or sell to buys that get engulfed, those are very high quality zones. And in this case, what do we get? We break structure to the downside. You see we bring a lot of momentum. We push down much lower, meaning that we don't really have any buy candles anywhere in here until we get what? This shooting star to the downside. And what do we get? The development of a range. We have this low to this high, break structure to the downside. The expectation is what? Continuation lower. Now if we look left, I'm sure we have something that we are reacting off of to create a pullback, right? Because that's what we expect happens back in the chart. If we look at it again, what are we expecting when we tap a previous, let's say, range, a demand range in this case? We can get a pullback on this to create a better supply range. So what are we expecting? We probably tap something to the left. We're not going to focus on that and go to the left because it's just not relevant, but that's the idea. So what do we get? When do we get our first demand range? Here, this high to this low, failed to make a new low, and we break out candle body closure here. Then what else do we have? This low to this high, failed to make a new low, break the structure to the upside. Now you could choose that wick. You could also go like this. Now what are sweeps, right? Sweeps, once again, I'm not considering them valid. It's just basically mitigating something in here. That's why I chose to include it. It's up to you. It would be very aggressive to include wicks in my eyes, so I simply don't. Here, what do we have? This high or this low to this high, break structure to the downside. When do we break the structure to the downside? Right here, right? Now the expectation is what? Well, we have this unmitigated range. That's a strong supply that broke structure. It's a buy to sell that got engulfed. We're probably forming a complex pullback, right? We're not really looking to take price short. Any shorts that are happening are simply to pull back price to mitigate something in a previous range. So while this is a supply range, what did we come into? We just came in to a previous demand range that was unmitigated, right? So this was a good supply or good demand. This was a sell to buy that got engulfed, right? Same thing here. Sell to buy that got engulfed. Price comes back to mitigate that on the previous level. So the whole idea here is you're not just forgetting supply and demand. Supply and demand is very important. You're simply using the idea of ranges to get when we are getting that shift, right? And you're using supply that's more refined within that range to clarify whether we've mitigated or not. Because if you're trading on a 1 minute time frame, sometimes you're going to be like, well, why didn't this wick get tapped? Why didn't the absolute extreme get tapped? Doesn't mean that it's not valid, but sometimes that mitigation is enough. Sometimes we can come just shy of an area, and if we still tap into the range, let's say the bottom of the range, it's still valid. Doesn't mean that let's say the buy to sell isn't valid. It just means that it's not going to be used until a later date. And if we basically come in to mitigate a range, let's say supply, and we come into the bottom of the range and we get, let's say, a reaction that breaks structure to the downside, well, then that could be enough. And that's why the idea of these ranges will show you, well, if we get a shift from, let's say, here, we can expect that more than likely, if price comes back into the zone, it's going to respect the entire range. Now, you could refine it, like in this case. Let's say price came in to tap something in here. We're on the 15-minute. Obviously, it could be something on the 1 minute. It can be on the 5 minute, whatever. We're not dropping time frames for the sake of this video, but look, in this case, what happens? Price comes in, taps what? These buy to sell wicks, and this satisfies the move. What do? We have this low, this high, we break structure to the downside. So for now, price is bearish. Now, you could be fixated on this specific extreme, but it doesn't mean that it will come back to it. So that's the idea behind the range. You use this with your own discretion. You know, it's very subjective. You have to learn how to use it, but it will help you better understand at the current moment who's in control, right? We have this buy to sell that gets engulfed. This is a pivot supply. We break structure to the downside, we continue lower, right? In this case, if price came back up to any of these unmitigated zones, it's valid to take shorts. If we come into a refined area in this range, it'll be much better, right? Now, areas that have been unmitigated like this, once we've satisfied this level, this range, although it's mitigated, somewhat mitigated, or to the 50%, it doesn't mean it will come higher. But if we're getting a shift to bullish, let's say temporary momentum, like in a pullback or something, then you can expect that maybe that's what we're coming into, and this will simply serve as inducement, right? So you would just want to be cautious of that. So here what we have, kind of like this structure, price pushes up. We have, where did this come into? Oh, that's going to be this move here. So we have this high to this low. Price comes in, finally taps the extreme, wicks, and takes out this level. It doesn't break structure to the upside because you see the candle body closure is below this one. So all we did was sweep it. We're continuing to the downside here. What do we have? This low, this high. When do we break structure to the downside? Right here. Then we have these internal levels, this low to this high. Same thing. You can just drag these out across, depends how you like to use them. What do we have here? So this was something that was interesting. So we have this level created this low. Price pushes up. What do we have? Price pushes back down. The expectation is that we're bearish. So my expectation was that this will close below. Because we got sweeps and no follow through, what this tells me is there isn't enough sellers at this level to push price lower. So that means that what? The high of this range, right? This high to this low means that this is weak because this is not strong enough to continue the move down. So this is going to go. This wick here is going to go, and we're going to break to the upside. So what do we have? Sweep. Price pushes up, breaks out of the top of the range, and what do we have? Sponsored candles to the upside, full body candle closure, and then we push back to the downside where we break structure. We break structure, this low goes across here. So what do we have? We have an unmitigated sponsored candle. This provides a beautiful, perfect entry at the 50%. What do we have? We're forming a supply range in here. We break to the downside, right? So if you weren't confident enough to take this alone, we have what? A supply range that breaks structure to the downside. And then what do we have? Price comes in, mitigates the supply zone inside the range at the bottom of the range, and continuation to the downside, right? We have this. This is a demand range. Price breaks and closes to the upside, but it only did that to come in to satisfy and mitigate this unmitigated supply. Then now we will have continuation to the downside with supply ranges. And that's this whole idea, basically. You don't have to use them everywhere and justify, let's say, every single spot because it might not be clear. But it's very helpful if you use it specifically at extremes or decisional points where we get shifts, right? At this point, this was what? This was a demand range. And then we have what? This level here. This basically is already the formation of a supply range. So supply range right here. Price is following through. We have this level that is what? We have a lot of doji candles, a lot of liquidity, showing a lot of weakness, no longer pursuing buying, and we get an engulfing candle to the downside, right? And so all these levels become relevant until they're breached. And in this case, what do we have? This swept, it did not break structure to the upside. So this is still valid. So when we break structure to the downside here, right, We're simply respecting these highs. Now let's go down to the way that I use this. I'm not very much someone who uses this on the 15-minute, but I know most people like the 15-minute charts, right? I prefer to use it 1 minute and sub 1 minute. So I'm going to show you now on the 1 minute time frame and on the 5-second time frame how I use it, right? So in this case, what do we have? These ranges here. Now these are pretty big ranges. They look very aggressive, but they're only on the 1 minute, but they're still, let's say, 30 pips. That's pretty big, right? So I have this high to this low, failed to make a high, break structure to downside. Once we break structure to downside and we have candle body closure below the range, this range is now valid and unmitigated until we come back into it. Price comes in. What do we get? Price comes in to tap the supply extreme. Look at this. We get a reaction. We have this high to this low, but what do we get? We break structure to the upside. So this is we are having a mitigation of a 1 minute supply zone that broke structure to downside. So this is technically a strong level, and we are having the formation of a demand range as a reaction to a 1 minute strong supply. So more than likely we can expect what? That this is going to go and it's not going to be respected. We usually prefer to see that, let's say if the higher time frame bias is, let's say, a supply, that we get a supply range formation as a result of mitigating it, right? So we would want this to be a supply if we were going to continue short. What do we get? Another high, low, break to the upside. We do get candle body closure a little bit above, whether you want to count that or not. But what did we merely come in to do? We just swept. We have no follow through, and so candle body closed below. We did not make new highs. We only swept that level and probably came in just to mitigate something in here, right? So we're still respecting this supply range. So now what do we have? A supply range forming after we swept a previous supply range, but we came in to further mitigate deeper into another unmitigated supply range. So now what do we have? This low to this high, break structure to the downside. Where do we break structure downside? We have a pause here in the market before we break structure lower. And then what do we have? Price comes back up correctively, taps the bottom of the range, and continues. So what do we have? This level could be considered unmitigated. Price comes in, reacts, and basically protects the range. Now, if you were trading an entire range on a 1 minute time frame, you could simply do this, right? And the expectation is what? That we make let's say a new low, right? And that this is going to go. And, 3R isn't bad, but that's not something that I like to do, right? So I wouldn't take it. I would take it only off of a more refined zone. If you took it off of a refined zone like that, let's just say protect the high there. And when the expectation is create a new low, that's almost 16R. And even if you were wrong on this one and price came a little bit higher, a 16R trade, you lost one, you got the second one, it's still 15R. So, I mean, there's a lot of ways you could trade that. Then we have this high, this low. This high swept, but still respected. Break structure to the downside. We get the follow through here, right? Price comes back in after break structure to downside, mitigates in here, right? The buy to sell wicks that broke structure, also forming another supply range. So we're just getting continuations of that. Now, on the lower time frame, when you see price gathering like this before an expansion to the downside, buy to sell wicks that get engulfed, right? Or buy that takes liquidity, sell that pushes back down and continues. These are important levels to watch. Now, doesn't mean that they're going to hold completely strong, right? I wouldn't just set limits on a lot of levels, but I'd like to refine down, let's say on the lower time frame, let's say go to the 5-second time frame to see how price is reacting, right? That's the whole idea. And so now I'm going to show you how I would do this and how I trade this on the seconds time frame. So we are going to look at this area over here. And we're going to go to the 1 minute first just to make sure we're in the right zone. Alright, we're in the right zone. So let's go down to the 5-second, and we're going to go all the way to the left. So this is a higher time frame supply, right? And we're just going to see how you can use this on the 5 seconds, because a lot of people think that it's crazy to trade the seconds time frame, that it might not make any sense, and that it just, why would someone trade the seconds time frame, right? It just doesn't sound like there's a lot of confidence people have behind it. But the reality is it's very clear, and it's exactly like trading the 15-minute, the 4-hour, the 1-hour, the 5-minute, the 1-minute, whatever. The difference is it just moves a lot faster, so you have less time to make a decision. But it works the same, right? So this is the supply zone that we had, right? Break structure to the downside. Now let's see what happens as price comes back to this zone, right? We could refine it and just say that it's these wicks up here, right? Or the candle closures there, or we could just, however you choose to refine it. We're just going to keep it like this for the sake of that. So coming into this supply zone, we have this high, low, break structure to the upside. We have a demand range forming. Price comes in and taps to the supply zone. And what do we have? A high, low, break structure to the upside, another demand range. So we're waiting to see when we flip. We want to see a supply range forming in a higher time frame supply zone. That's the key to this, right? So what do we have? This high to this low, failed to make a new high. We form equal highs, right? Equal highs. We came in to tap the absolute extreme. Maybe this even wicked a little bit above the supply zone initially, right? Maybe it even came into what? To this zone. Maybe if we refined it like this, right? Looks like that's probably what was more clear. We had these equal highs. We took them out with this level. We also formed more equal highs here, right? And what did we do? We got a supply range forming after tapping the unmitigated supply. An unmitigated supply. So we break to the downside, and what's special about this one? We don't just take out this demand range in here, but we take out on a swing here. Now obviously we're on the seconds time frame, but let's just say if we have it like this marked out, what do we have? This break of structure makes the supply strong. And so now what are we going to expect? We're going to expect that the high is protected, the lows are weak, as we just saw we violated and we broke this demand that initially pushed price into the zone. So now this level should hold. The expectation is now what? Continuation to the downside. Now we have these equal levels here, these equal highs. So what does price do? It comes in to sweep it. Now it didn't necessarily need to, right? We could leave those behind and just take the whole range. If you were going to trade the range and take, let's say, half of it as a trade, as long as it doesn't break, that's a 1 pip stop loss. And obviously your target would be all the way to the bottom to create a new low, right? But at the same time, let's just say we waited for that. We have a refined supply. This one broke to the downside, still respected this level. These equal highs were responsible for break of structure to the downside. So what do we get? We have price coming back up after we broke structure. We're getting a pullback, right? As we expect when we take out a level. We have this high, the low, high respected, break structure to the downside, another one. So what do we have? This is a supply range. Now this low has not yet been violated again, right? So let's just mark this out for when this does break. But we already know we're bearish. So now that we've respected this high, you can take a pretty good guess that we would want to go short. Now obviously we would leave a little bit of protection to this. We would like to protect the highs just a little bit. So if it was here, even based off of spread, maybe you wanted to, add a little bit, like a 0.3 or 0.5 pips to whatever, right? I'm not here to show you how to take entries on them necessarily, but more to show you how to use them on the seconds time frame. Now this high is responsible for break of structure to the downside, right? We have a supply here. This simply does not get mitigated. We have formation of equal highs here. Maybe we come back to it, right? But this is how we trade 5-second reactions to supply zones on the 1 minute or below, right? Now we have this range. We now know we're bearish, so we're expecting continuation. This high, this low, this high holds, respected, break structure to the downside. So because this happens, we are no longer expecting that we will come back to this level right now. We could return to it later, but it could also be left behind for a later date, or once we fulfill the higher time frame move, which is break structure to the downside, maybe we come back to mitigate it. But we know that this supply range is valid and has been holding, right? What do we have now? we have, low, high, failed to make a low, failed to make a high, failed to make a low. Then we have buy to sell that's engulfing. So you can refine it like that, or you can just move it down a little bit lower like this, up to what you want, but it's a range. Price pushes lower, we have a pause. Here, what are we creating? A small lower time frame range, the low to the high, expansion to the downside, break structure. Now what happens here? Price comes up and sweeps, breaks structure, and takes out this supply range. Now, it's a small supply range, it's valid, but it simply just doesn't have enough liquidity to continue to move to the downside. We did have a pretty big void that we left behind here on maybe on the 1 minute time frame as we got this push to the downside. So price came in to mitigate that zone, right? But shorts are still valid because we can still tap any unmitigated supply ranges above without breaking structure. So price can come into this zone or to this zone, right? And we're still valid. We're still short, right? The whole idea here is we're taking entries at unmitigated ranges so long as we are continuing to the downside, right? So in this case, what do we have? This high, this low, price comes in sweeps, sweep of the lower high, right? Break structure to the downside. We have all these internal lower time frame ranges that you can also on the 5 second that you see are valid. Once we break out from here, what do we have? This high to this low, break to the upside. So now what do we have? We've liquidated 1, 2, 3 demand ranges. We've made relatively equal highs with this area, except not with the sweep. So we've respected the wick here. So at this point, what are we seeing? We're seeing aggressive demand ranges forming. We have this one here. Price comes up, pushes lower. We have this high to what? This low to this high. This is when we get the candle body closure. You can see internally we do have some supply ranges and we have an extreme demand range that has formed. So, all right, so as you can see, so I had to pause it because my dog needed lunch. So we can have internal ranges within internal swings, right? Or minor swings and substructure, right? So while we have a minor, let's say lower high, lower low, right? Until the lower high goes on this minor structure, right? We are still expecting to go bearish. But when we see on substructure is creating, let's say, ranges that are bullish, let's say like this, we continue to make more. What we can expect is if these demand ranges are holding, then what we're going to see is we're going to break out of the expectational order flow on the, let's say on the minor, we're going to have a break and we're going to now shift. And so when we shift, if we got a break and a pullback into a range that has been unmitigated, we can expect continuation, right? So this is just further going to help you gain confidence when trading, that you don't necessarily need to be like, well, if I didn't get this extreme, then I'm simply not going to take a trade long, right? Because, in the past, this is something that I do too. I'm like, gosh, well, I have this unmitigated demand and I'm seeing that, price already has come up here. We're forming this extreme. I'm like, I'm going to wait until maybe equal highs and then we break structure to the downside to, sweep those levels and we come into tap. And then I'm going to wait for like a 5 second level and then continue up until we get here. And then I'm going to go short. You will lose a lot of opportunities if you only think that way. And so it's okay to be wrong. And you don't take points away from yourself when you are seeing that, oh, maybe it didn't work out this time or it does work out. Just have more confidence behind it, because when we see that we're forming demand ranges and we're mitigating them or we're respecting these levels, it's going to help you a lot better to see that we won't necessarily violate these. I might just set up, for example, like a buy stop that if we break up, out of this range, the expectation is what? That we're not going to breach this demand. And what can I safely do? I could safely take that. Look at this. It didn't do that. Price came in, hit my take profit before we even came back down, right? Because there's no need for price to violate a range that took billions of dollars to create, simply because we need this to further support the move to the upside, and we need this to serve as liquidity on the downside when we shift back lower, right? When price comes back lower, we're going to take out all these levels anyway. So there's no need to violate them now. So feel confident taking trades off of stuff like this when you start to see price shifting, right? Even if you didn't see this, because let's say we were, more in hindsight, if we were already breaking up from this level, what do we see here, right? Once we start to violate and break supply ranges, you could have a little bit more confidence behind it. And once we saw this, we came out, made equal highs. We already took out these supply ranges. We're making another demand range. If this continues and you just decided to take a trade from the 50% of this range, protecting the lows, this is a pretty good trade. There's nothing wrong with taking a continuation like that. That's absolutely valid, right? And so that's something to keep in mind. So as you see, we're making more demand ranges and we are not violating them. Sometimes you'll get sweeps. It's not often, right? What do we have? Demand range. This pushes price up. This is a pretty big one. We create lower demand ranges in here that just continue to take price up. We have what? Price hits the supply. This is more of a decisional, for the supply range, right? We'd have yet to come into this one because what? This is just not necessary for the move that we have, right? So what do we have? Price comes in, taps. We take out the demand range 1, take out demand range 2. We swept it, right? And then price comes into what? Well, we have an unmitigated supply, refined supply on a 5-second time frame of a demand range. This could hold. If we see a reaction from here holding, price pushes back up and we're forming what? A demand range. What can we expect? We can take a long from here. You can then say, well, I'm confident in taking a trade like this, right? Back to supply. Because what? Demand is holding. Maybe we need to sweep that and come a little bit higher, right? We still have other levels that we would potentially be targeting, right? So we continue. Price comes back in to tap what? This demand range, right? We have break of structure to the upside. Now, to extend it to show you where it would be valid, this is where we get the candle closure above, right? We have 1, we have 2, we have 3. And then what do? We get a supply range formed as a reaction to an unmitigated extreme of a supply that broke structure. So that tells us what? This is going to be a very valid place to trade from. It would be great to take a short from a valid supply range that broke structure to the downside, right? That mitigated a refined extreme of another range supply that broke structure, right? And so you could take a trade off of that. Once we have this, I mean, we could consider this maybe that it did break out. That's up to you, right? If we did it like this could be a demand range. Obviously, the demand range would fail. And so immediately after having this, let's say, be serving as a demand range, you would then switch it back once you saw that it failed, right? And so now we have what? Buy to sell that took liquidity, that got engulfed. This is a valid area to trade from. Now, what would someone want to trade from? You could trade from the entire range, or you can trade from what? Where the flip came from. So sell to buy, sell. We have a pause here, and then we push lower. So from the bottom of this range here, look how clean that is. Price comes back up. Where do we get the shift? Here, this is something that you can just do like I was mentioning earlier. You can just do the demand ranges or supply ranges at extremes or decisionals, right? This helps me understand where we shifted bullish, because this is where we got the expansion to the upside. This high to this low, break of structure to the upside. Look at that. Came back in to mitigate this level, created equal lows. That's more liquidity to fuel the move to the downside as we tapped a higher time frame supply zone, right? Price came into here, engulfing candle to the downside. Someone else would say, I'm not going to take a short unless we come back to this level because it's unmitigated. And while that's valid, you could do that. Let's just see what happens here. Did we get something there? Nope, nothing until we breach that level, right? But what do we have here? We have more ranges, supply ranges. We have one here, right? What happens? Price breaks out lower, comes in, mitigates this level, whoops, and we can get another trade from this unmitigated supply. Pushes price lower, right? We now have the formation of another supply range. Price comes in. Once we invalidate this level, we come in. What do we see that's forming? So here we have this. This is a demand range that pushes to the upside. Now what does it come in to what? To mitigate what? The bottom of this range? You could have marked out this entire zone. It's up to you, right? But you know, we do have a sell to buy here that got mitigated. Simply what we're just doing is building liquidity to take onto the upside, right? So that's the whole idea. Once we get price to come back into what? This supply zone, what do we see? We have demand ranges until we come back into what? To tap the zone. Price comes in. We refined it, so now it doesn't necessarily come into tap, but we do have these levels here. So let's say if we refine this to this, then it does tap. And that's an unmitigated 5-second extreme, right? We go bearish here, we break structure to the downside, but what do we see? We are forming what? More demand ranges. So more than likely we could potentially sweep that, or we want more confirmation, right? We would like to see something break in here. We could see this break, which doesn't happen until much later, or we can see something else go and see more confidence with more supply ranges, right? So I have a supply range here, breaks to the downside, supply, supply, pulling back up, complex pullback, respects the highs, makes the supply range to the downside, comes back up. What do we have? Simply another what? Mitigation, forming a lot of equal highs here. There's a lot of liquidity that might scare some people away from this, but we stick to the ranges, right? Supply range, this is a bigger one, breaks to the downside, giving me a little bit more confidence. We have this unmitigated zone here. When price comes into tap, you can just clean the highs, 0.8 pips, obviously all the way to the downside, right? And you know, we can keep dragging this even further. That's the whole idea behind ranges. We just want to see how price reacts. If you're using it on the sub 1 minute time frame like I am, for example, we are going to focus on a 1 minute point of interest that could be refined down to 15-second or 5-second, whatever, that's unmitigated, and you're simply trading the reaction. You're using the ranges to take away the noise from all the up and down movement that you might not be understanding. So this will clarify when you start to see what's actually happening. There's demand, 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 supply, demand, demand. These demands do not break supply, so supply is stronger. Supply, 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 mitigating of the supply zone, respecting, bigger supply range, more to the downside, unmitigated supply, tap it, run, right? So that's how you use it on the seconds time frame. Like I showed you, you can use it just on the 15-minute time frame just to understand what's going on, right? If we are trading, let's say, the higher time frame market structure, right? We have, like, let's say this low, this high, this low, this high, this low, this high, this low, this high, continuation to the downside. The expectation of the higher time frame market structure is lower lows, protect the highs, target the lows. Therefore, we can get a better understanding using ranges of when we are getting that shift. When we see a supply range form in a supply zone that breaks structure, and we have several confluences telling us with the higher time frame market structure that we should be looking for shorts, that gives us a lot of confidence to take when price comes back in to mitigate the range, whether it's the whole range, the bottom of the range, or a refined zone within that zone, right? So use that. Hopefully that is helpful to you guys. I'm going to put the link to this specific chart that I have here that I just made earlier today. So just remember, there's different ways you can look at it. You have bearish, you have bullish. Most cases we're going to find continuations. Most trades are always going to be continuations, but there will be the times when you get the reversals, and this is very powerful to help you gauge when we get the reversal and where the continuations are so that you can trade through those areas. Remember that it takes a lot of money to build a range, and it's unlikely to be breached until we've reached the higher time frame intentions, right? If we're continuing to the downside, then we are not going to take it until we fulfill a new low. there's no pullback, there's no reason to continue, there's no reason to liquidate those areas, right? So stay tuned for the next video. I hope you enjoyed this one, and I'll see you next time.